I'd start by saying that we don't think the Australian banks are particularly attractive anyway on an Australian basis. They look like reasonably low growth businesses over the next 5 years, and that's a stark contrast from 10 years ago when credit growth was running into strong double digits, and as a result their earnings were growing strongly, and of course their share prices and their dividends have increased strongly as well. A lot of Australian companies now have had to look overseas because they've exhausted their markets here in Australia, and we find the ones who are doing the best are the ones that have a really good idea here, they're quality businesses, and they can take that idea and roll it out in foreign jurisdictions. So I'm thinking of companies like Domino's Pizza, which we have a pretty solid holding in. There's a business started in Brisbane, has accessed the global Domino's franchise and has expanded into France and Europe and more recently into Japan, and they've done a very good job of doing so. They've taken a model that works here, they've modified it accordingly for those other countries, and they're having great success in rolling out that business model. That's the sort of growth we're looking for in our portfolios, not single-digit growth, because I don't think end investors are all that keen on single-digit growth. I think they want more than that, and they need more than that given the fact that many other asset classes are not doing so strongly, and they're the sort of businesses we think that can deliver it. Both of those funds have performed very, very well. In fact, over 10 years, they are the leading funds, Australian equity funds in their particular asset class in Australia. I think they're 1 or 2, depending on which month the survey comes out. Those two funds, particularly our Small Growth Companies Fund, has been able to achieve a very strong long-term absolute performance as well as an outperformance over the market. The reason the Small Growth Companies Fund has done so well, there's a bit of focus in the last year or so on small companies as people have looked for alternatives to the top 50 and the banks, because I think a lot of fund managers are starting to look at the banks and starting to underweight them as they share our view. But a lot of the companies in our Small Growth Companies Fund are the type of companies I'm talking about here. They are the Irises and the Domino's and those sort of businesses who are taking their businesses offshore. However, they didn't suffer as much through the GFC because a number of them hadn't actually done that then. They were still filling out their Australian business, and they were somewhat quarantined from the effects of the GFC. So that fund did a lot better during the GFC than maybe our main fund, even though I think in 2009 it did 0 return when the market did nearly -20. And that was largely because high quality businesses perform well in difficult times because they've got the earnings growth. It's not the strategy. We look for a business that's capital light, that has high levels of intellectual property that would enable them to go and access other markets, but they don't necessarily need to be an international business, although that's a bonus. I mean, we have many businesses here that up until 2 years ago that we owned and made good money for our clients in, that were just Australian businesses, but increasingly those businesses need to look offshore to expand for the next 10 to 15 years. And if they've got a very good idea, I mean, one of the best ones I think we've come across that's expanded internationally has been REA. It's still very early days in its international expansion, but it's a demonstrable success here in Australia in capturing a huge proportion of the online real estate advertising component. And we're looking for what it can do in the future in other markets.